Welcome back. You're watching Markets at Noon, and let's now gauge the market breadth amid volatility. Let's talk fundamentals and the larger play with a well-known market expert. We have Devang Mehta, Deputy Managing Director and CIO, Equity and PMS, Spark Capital Private Wealth with us. Devang, Mansi this side, good afternoon. Thank you so much for giving your time to ET Now.
Good afternoon, Mansi. Thanks for having me on the show. Always a pleasure to be on 18 Up and interacting with you all.
Pleasure, for us as well, Devang. And to start with, I would want to talk about the India's growth outlook. And as we see, the geopolitical tensions have almost on the face of it gone. And as we see, India has a lot to look towards and a lot positive to look towards. The seasonality factor, the onset of monsoon, the GDP numbers, the good manufacturing upkeep. What do you feel is the texture of the Indian markets as far as the growth outlook is concerned?
I think there has been a lot of improvement in fundamentals, in macros, in micros. I think what happened across from September to April, I think we had 8 difficult months of market where not only markets corrected, but I think sectors, businesses, everything corrected. And there were reasons for that, right? In hindsight, we know that there was no capex happening, the consumption was suffering, inflation was sort of not trending down, your global geopolitical tensions, you had tensions in our own backyard. So I think a lot of such things have now suddenly vanished. The last 2, 3, 4 months, if I can just dissect the data points, and you talk brilliantly about that, is that the GDP growth sort of is again on an upward curve. Clearly, the inflation has come down drastically. We are at a 5 or 6 year low, if my memory serves me right. RBI has been on a rate cutting spree. We know that around 100, 125 points have been already cut, and CRR by 100 points, of course, phase wise. That has infused a lot of liquidity to the markets. It has improved the sentiment of the economy and markets as well. I think whatever government did in the last budget to boost consumption or to boost investment, that has also taken shape. The most important point again is capex, sort of which was dwindling last year because of state elections and the national elections. I think that has also come back with a roar from the government side at least, and we are hearing that private capex is also sort of starting a bit slow. I think all these things together, if you put at and in fact, if you look at the company's numbers last quarter, and I know we are also at the start of the new earnings season, I think most of this, if you place in point, we are in for good times. Yes, there may be smaller corrections on the way, but I think the texture of the market, the color of the market looks interesting, and I think there will be more green than red if you look for the next 6 months, 1 year.
Interesting times and more green than red. I'm sure our viewers are catching up on that line, Devang. Okay, but then let's talk about specific triggers now. I really want to know your expectation from the Q1 earnings now, which are a few days ahead. And having said that, a lot of pressure and interest in the IPO market as well. How are you looking at, and what are your expectations from the new financial year first quarter results as well?
I think yes, this quarter seems to be one quarter where you will sort of lay down the foundation stone for what is going to come over this year. I think more importantly, numbers. I think we can probably there'll be a bit of miss and there'll be a bit there'll be hits as well. But most importantly, what the management talks about for each sector, for each theme, for an individual company, what is their body language, what is the commentary, and whether they are positive on not only on the economy but on a particular sector where we know there are tailwinds for certain sectors like capital expenditure. We already know there is capital goods, infrastructure, power automation. There will be good numbers because the order books are sort of getting more and more orders. These companies, there is execution capabilities being showed by a lot of such companies. I think also domestic consumption seem to have improved. More so the upper end consumption and even the lower end consumption. I'm hearing even in the RBI report they have talked about a bit of rural consumption improving. So I think you probably will see some green shoots over here. Financials, some banks, some financial companies, be it depositories, exchanges, wealth management, this can also come up with good set of numbers. I think there is wherever there is global dependence, maybe IT. I think yes, the stocks have corrected big time, but companies in the IT space, companies in probably who are into exports, they might face a bit of a difficult time. I'm not saying the numbers will be very weak, but I don't feel there is enough scope and enough wherewithal to sort of give great numbers over there or see robust profitability and revenue growth. I think this couple of sectors would be sort of a miss, but the sectors I talked about initially, I think there are a lot of green shoots we can see.
Green shoots will be seen in financial sectors, depositories, wealth firms, and at the same time, capex related theme is also another one which is coming in from Devang Mehta. Devang, another thing on the indices. These days, there is a scenario, of course, sector wise also, we see a lot of sectoral churning which happens, but at the same time, broader markets versus the benchmark is another talk in the town as well. What's your view with the broader markets performance, because broader markets do see good flows, and is it going to outperform the benchmarks, or one should stay with the promising benchmarks?
See, I think it's a very good question, and that's very close to my heart to answer this question. In fact, as I always say, that India's market cap today is somewhere around, say, $5 trillion, around 450 lakh crores is the market cap that India has. There are only four companies which are sort of about 10 lakh crores. There are around nine companies from 5 lakh to 10 lakh crores, and from 1 lakh crore to 5 lakh crore, there are around 82 companies. So I think the bulk of India's companies, a lot of companies are below 1 lakh crore. You can call it mid caps, you can call it small caps, or you can call it larger mid caps. But there is a lot of companies or a lot of sectors or themes which are emerging out of this. For example, if you today look at the construct of Nifty, 35% is financials, around 12-13% would be oil and gas, around 13-14% would be IT, 8-9% would be conventional FMCG type of consumption themes. So 70% of Nifty is already, I think, the companies which have done well over the last 3, 4, 5 decades. But a lot of companies which don't find representation in Nifty are into the broader markets, are placed in the broader markets, and a lot of such themes which you can play, as I always talk about: engineering, manufacturing, capital goods, power automation, smaller discretionary consumption names, some innovative pharma companies, and again some of the financials which are not a part of Nifty right now. But I think there is a lot of scope for such type of companies to enter the key indices over the next 5, 7 years, once they probably grow in market cap and free float as well. So my sense, broader markets today, probably if somebody has a 3 to 5 year horizon, you need to look at a lot of broader market participants as well. Not saying Nifty would not do well. Probably once Nifty can give you the earnings growth of 10, 12%, 13% over the next couple of years. But I think there will be a lot of companies in the broader markets where earnings would grow at 15, 18, 20, 22% as well.
Devang, just to elaborate on this, I also want to know the sectors that you are cautious on right now, sectors where you were really bullish and riding high on, but now it's a time where, due to several factors, you might just want to have a cautious approach on it.
Yeah, I think wherever there is a bit of global dependence, and I'll categorically say that it's not that you need to stay far away from there, but you need to face a bit of volatility and music, because you know that nowadays global markets probably every single day you change the narrative. Companies which are linked to maybe tariffs, yes, I know there is some solution in sight, and that's also sort of settled down. But most importantly, I think companies which are into the export domain, bit of IT, companies like metals. Again, I'm not saying metals will not do well. It might do well over the longer term, but you'll face a bit of volatility because you don't know what happens to the Chinese situation in US and Europe. So that is where a lot of volatility come to the proceedings, and also be part of your portfolio if you are more dependent on global circumstances rather than local. So my sense is that there is so much of domestic opportunity right now riding high, that you don't need to go and sort of buy companies with global linkages. That's the sense that I get.
All right, Devang, thank you so much. That felt like a 360-degree analysis on the markets. Thank you so much for joining with us and talking to us about your analysis on the markets, as well as the sectors and overall economy. Have a nice day to you.